Standard Chartered shares jumped 4.3% to 2,187 pence on Wednesday, after the bank posted a record first-half performance. Second quarter pre-tax profit came in at $2.33 billion, 13% ahead of consensus, with earnings per share of 77.4 cents beating forecasts by 17%. The beat was not a single-line surprise. Wealth Solutions revenue climbed 43% to $1.06 billion, 16% above expectations, as 60% of net new money flowed into investment products, compared with 20% a year earlier. Operating costs ran 2% below forecast, and credit impairments of $150 million came in 37% under consensus. Standard Chartered used the results to raise its 2026 income growth guidance to the midpoint of its 5 to 7% range and announced a further $1 billion share buyback, on top of a 66% increase in the interim dividend. On every visible measure, this looked like an unambiguous win for the bank. Yet Shore Capital, one of the analysts covering the stock, kept its sell rating in place even after the beat. The broker argued that consensus forecasts already reflected the upgraded guidance, which limits room for further earnings upgrades from here. Shore Capital's price target of 1,725 pence sits well below Wednesday's closing price of 2,187 pence. The broker warned that a full valuation could restrict further gains, even though the quarter was strong. Jefferies, reading the same results, called the bank's cost discipline striking and said the results showed notable strength in the mix of wealth income. The same quarter produced a bullish read from one desk and a valuation warning from another, with no new information separating the two. The split is not about whether the quarter was good. Both sides agree it was. The disagreement is about whether a stock already trading well above a sell-rated target has room left to reward new buyers, or whether the good news is already priced in. Capital strength supports the bullish case. The Common Equity Tier 1 ratio strengthened to 14.2%, up 77 basis points on the prior quarter, and around 50 basis points above consensus, even after accounting for a new buyback expected to reduce that ratio by roughly 38 basis points. For a holder, the record quarter does not settle the question of whether to keep riding the position or trim into strength, because the bank's own fundamentals and the market's valuation of those fundamentals are now pulling in different directions. The clearest forward signal in the results is the shift inside Wealth Solutions, where 60% of new client money is now going into investment products rather than deposits, up from 20% a year ago. That mix shift, if it continues, would keep supporting the higher margin income the bank is now guiding toward. Standard Chartered's operating evidence, from cost control to impairments to the wealth mix shift, is stronger than the headline profit beat alone suggests. But whether that evidence still translates into share price upside from here depends on a valuation judgment the sources themselves have not resolved. The record quarter is not in question. What it is worth at 2,187 pence still is.